Every financial crisis is sold to you as an accident, shock, a once-in-a-generation failure no one could have seen coming. Experts appear on television, shaking their heads, promising investigations, reforms, and lessons learned. But there is a disturbing mystery hiding in plain sight. If these crises are truly random failures, why do the same people always come out richer on the other side? Why do millions of ordinary people lose jobs, homes, pensions, and years of progress, while the largest financial institutions not only survive, but grow larger, more powerful, and more protected than ever before? This isn't a coincidence. Once you see the pattern, it becomes impossible to unsee. To understand what's really happening, we have to stop thinking about financial crises as disasters and start viewing them as mechanisms. Modern finance is not just about money moving through markets. It is a system of privilege, timing, and access, one designed long before you were born. At the very top of this system sit central banks, global financial institutions, and those with direct access to newly created money. Below them are corporations, hedge funds, and large investors who can borrow cheaply, survive downturns, and buy assets when prices collapse. And at the bottom is everyone else: wage earners, small business owners, retirees, people who experience the economy not as numbers on a screen, but as rent, groceries, and survival. This structure didn't appear overnight. Its roots stretch back centuries to the earliest experiments with debt-based money. When governments discovered they could borrow instead of tax, and banks realized they could lend money they didn't fully possess, a powerful idea was born. Control the creation of money, and you control society. Early banking families learned something critical. Whoever controls credit controls growth, and whoever controls growth decides who wins during expansion and who survives collapse. As financial systems expanded through industrialization, leverage became the engine of growth. Borrowing allowed empires to build railways, factories, and armies. But leverage also created fragility. Every boom planted the seeds of a bust. Yet even then, insiders noticed something remarkable. Crashes didn't destroy wealth equally, they redistributed it. By the early 20th century, this pattern was unmistakable. During the Great Depression, stock markets collapsed, banks failed, and unemployment exploded. Ordinary people lost everything. But those who held cash, political connections, or control over credit bought land companies and resources at pennies on the dollar. Depression didn't eliminate wealth, it moved it upward. This was the moment when central banking became cemented as the solution to crisis. The promise was stability. The reality was selective rescue. When banks fail, they threaten the entire system. When households fail, they are considered expendable. Fast forward to the late 20th century, and the same playbook appears again, only faster and larger. Deregulation allowed banks to grow massive. Financial instruments became more complex. Risk was hidden, repackaged, and sold as safety. Credit expanded far beyond real economic growth. Wages stagnated, but debt filled the gap. This led directly to the breaking point of 2008. Housing prices soared not because everyone suddenly became richer, but because cheap credit flooded the system. Banks issued loans they knew many borrowers couldn't repay. Those loans were bundled, sold, insured, and leveraged again and again. The illusion of prosperity spread until it collapsed. When the system finally cracked, the story repeated with brutal clarity. Millions of people lost their homes. Retirement accounts were wiped out. Small businesses vanished. Yet at the same time, governments and central banks injected trillions into financial institutions. Banks were rescued. Executives kept bonuses. Asset prices rebounded, benefiting those who already owned assets. This wasn't an accident. It was cause and effect. Those closest to money creation receive support first. By the time stimulus reaches workers, prices have already adjusted. Assets inflate. Costs rise. Savings lose purchasing power. What looks like recovery on paper feels like permanent loss in real life. After every crisis, leaders promise reform. New rules, new oversight, new safeguards. But the fixes always fail or are quietly dismantled. Why? Because the system cannot be fundamentally reformed without threatening the power structures that depend on it. Each cycle follows the same script. Easy money fuels expansion. Debt grows faster than productivity. Inequality widens. A trigger event exposes the weakness. Panic spreads. Markets crash. Central banks intervene. Wealth consolidates. Then the story resets. Look at modern parallels. After 2008, inequality surged. The richest accumulated historic levels of wealth, while wages lagged. During the pandemic crisis, the pattern accelerated. Global markets collapsed, then recovered at record speed, while millions struggled to pay rent. Stock markets hit all-time highs as food prices soared. This is not because elites are smarter or work harder. It's because they are positioned closer to the source of money and decision-making. They can borrow when others cannot, can wait while others are forced to sell. They buy distress while the public absorbs loss. The shocking truth is this: crises are not interruptions of the system. They are the system's cleansing phase. They eliminate competitors. They force consolidation. They justify emergency powers. They reset ownership. This is why the same institutions become too big to fail again and again. Size is not a risk, it is protection. When collapse threatens everyone, rescue becomes politically unavoidable. Losses are socialized. Gains remain private. And here's the most unsettling part. The system requires public belief to function. People must believe crashes are unpredictable. They must believe recovery means fairness. They must believe hard work alone determines outcomes. But history tells a different story. Every major crisis transfers wealth upward because the rules ensure it does. Those who control liquidity survive downturns. Those who rely on wages do not. Those who own assets recover faster than those who depend on income. So what does this mean for you? First, understand that financial crises are not equal opportunity disasters. They are asymmetric events that reward position, not morality. Knowing this changes how you interpret headlines, promises, and panic. Second, recognize repeating patterns. When debt explodes, when asset prices detach from wages, when central banks signal emergency measures, these are not random signals. They are warnings that redistribution is approaching. Third, realize that waiting for the system to fix itself has never worked. Each fix preserves the structure while increasing concentration. Stability is promised. Dependence is delivered. The open-ended question is this: if every crisis strengthens the same hierarchy, how many more cycles can society endure before trust breaks completely? Because systems don't collapse when money runs out, they collapse when belief does. If this perspective changed how you see financial crises, share it. Subscribe for deeper breakdowns of power, money, and systems that shape your future. And remember, understanding the pattern is the first step toward not being crushed by it.